Thank you for joining us this morning, this afternoon, this evening. Again, apologize for the delay. Technical difficulties. My name is Doug Weil. I'm a partner at Hodes Weil in New York. This is a webinar presentation of the 2015 Institutional Real Estate Allocations Monitor. The Allocations Monitor is an institutional survey that is jointly sponsored by the Baker Program in Real Estate at Cornell University and Hodes Weil and Associates. We will spend about 30 minutes on the presentation, and we will follow with Q&A. At any time, please feel free to type in a question in the Q&A box, and we will try to get to as many questions as possible. This webinar is being recorded for replay, and a full copy of the report will be available on our website at hodeswile.com following the webinar. We will also email a link to the survey as well. Quick disclaimer. This presentation is only intended for institutional and/or professional investors. This material is intended for informational purposes only and should not be relied upon to make any investment decision. At this time, I'm pleased to introduce Dustin Jones, the Director of the Baker Program in Real Estate at Cornell University.
Good morning. On behalf of Cornell University, I want to thank you all for dialing in to listen to the results of our research and our survey. It's always a privilege to leverage our academic resources at Cornell University and also to partner with institutions such as Hodes Weil, who are recognized in the industry. We've utilized our graduate research associates, Ryan Chow and Aditya Dovakar, in conducting the research for this report. The report gauges the impact of institutional trends on investment management industry, assesses the role of real estate in investment portfolios, analyzes target and historical returns in institutional portfolios, assesses investor sentiment and conviction towards the asset classes, analyzes trends in institutional capital allocations. We're very confident and believe that this establishes the most comprehensive annual assessment of institutional allocations to and objectives in real estate investments. This is our third year conducting this survey, and I'm very confident with the findings. The methodology that we used included about 34 questions that focused on portfolio allocations to the asset class, current and future investments, historical and target returns, investor conviction, investment management trends, and the role of real estate in investment portfolios. And each of these 6 question results and findings will be discussed in this presentation. We launched our survey in May of 2015 and closed it in October of 2015, this fall. We surveyed approximately 3,000 institutions. We had 242 participants representing $11.2 trillion of AUM and over $950 billion in real estate assets. The 242 participants hailed from 30 countries. 162 participants were in the Americas. 49 participants were in Europe, Middle East, and Africa. And then we had 31 participants in the Asia-Pacific area. With that, I'll turn the time back over to Doug Weil to continue announcing the results of our findings.
Thank you, Dustin. First, I'd like to take the opportunity to thank Cornell for the partnership on this project for 3 years now. It's been a tremendous partnership, and we really enjoy the support. For those who are not familiar with the Baker program at Cornell, it's a 2-year graduate program, very high-quality program. We continue to be extremely impressed with the students that we meet and that we work with. And the program's goal is to educate the next generation of real estate leaders. We've enjoyed, as I said, fantastic support and assistance from a number of graduate students. I don't know how they find time on top of their studies to do the work that they do, because I know they put in quite amount of time. And our current team of Ryan and Aditya have really been fabulous. So turning to some of the findings, just in summary on slide number 8, institutions continue to allocate significant capital to this sector. Target allocations are rising, albeit at a moderate pace, and investors remain significantly underinvested in real estate. At the same time, institutions have generated strong returns over the past 3 years. We'll talk about returns relative to their benchmarks as well as industry indices. But the cross-current that we're seeing is that institutions are increasingly concerned about asset pricing, rising interest rates, and geopolitical risk. and this is resulting in a decline in conviction. While the appetite for core remains robust, investors are increasingly emphasizing value-add strategies. In terms of target allocations, the average target allocation currently stands at 9.56%. This is up 26 basis points from 2014 as compared to the change from 2013 to 14 of 40 basis points. Further, institutions expect to increase their target allocation by an additional 29 basis points over the next 12 months, which would bring target allocations to 9.85%, or just shy of 10%. It's interesting to note that the increases are not uniform across all investors. In particular, there's a meaningful divergence in allocation trends between larger and smaller institutions. Larger institutions, which we define as institutions with AUM greater than $50 billion, exhibited an increase in the target allocation of 70 basis points, up from 9.3 to 10%. And at the same time, smaller institutions at less than $50 billion of AUM had a 70 basis point decline. In viewing allocation trends by type of institution, we also found interesting differences. Endowments and foundations, as well as private pension funds, for example, lowered their target allocations year over year by 70 basis points. This is not entirely surprising, as these types of institutions have been slow to return to investing post the global financial crisis, and in many cases had challenging performance to overcome. We'll also talk about conviction during this presentation, and we'll note that endowments and foundations in particular have exhibited a significant decline in conviction. On the opposite end of the spectrum, public pensions and sovereign wealth funds have increased their target allocation by 110 basis points and 90 basis points respectively, and likewise, from a conviction standpoint, are relatively bullish. Looking at the percent that institutions are invested today in real estate relative to their target allocation, what we define as the current allocation margin, is a good predictor of capital flows to the asset class. And despite the robust level of investment activity and transaction volumes over the past 12 to 24 months, as well as favorable investment performance, investors remain significantly underinvested relative to their target allocations. On average, the current allocation margin is negative 110 basis points, or in other words, institutions are 110 basis points underinvested relative to their target allocation. This is a fairly significant margin, and when you consider it in the context of the fact that institutions globally have 60 to 80 trillion of AUM, it's quite a staggering number. This margin has also increased over the past 12 months from 80 basis points in 2014 to 110 basis points. One of the factors that we noted in our research that contributes to the widening of the margin is the pace of realizations, which we understand surprised a number of institutions that didn't expect to see such a volume of return of capital. And for one investor, he indicated that this presented a reinvestment risk for his portfolio. Viewing allocations on a regional basis, every region of the world has a negative current allocation margin. In the Americas, the average target is 9.4%, and institutions have the lowest current allocation margin at 80 basis points. This is likely due to the fact that institutions in the Americas have very mature portfolios and also were very active following the global financial crisis in deploying capital. Whereas institutions in Europe and the Middle East have the lowest target allocation of the asset class and a negative margin of 100 basis points. This is interesting, which we'll talk about later, in that European institutions are the most bullish institutions in the world today. And then finally, in Asia, Asian institutions have the highest target allocation at 11.8%, and they have the widest margin, current allocation margin, at negative 120 basis points. Finally, a look at a breakdown of the percent of institutions that are over-invested versus under-invested in the marketplace. And you'll note that a majority, or approximately 59% of institutions, are underinvested by an average current allocation margin of 220 basis points. We'll note that this is down from 65% in 2014, but still a substantial number and a pretty wide margin. Whereas 41% of institutions are at or in excess of their target allocation by an average of 150 basis points. At this point, I'll turn the presentation over to my partner, David Hodes, who will talk about investment returns and conviction.
Thanks, Doug. As he mentioned, I'm going to talk about the survey results initially with respect to historical investment returns. We asked the survey participants to specify their 3 prior year actual results relative to their target returns. The findings were very interesting. The 3-year average return through year-end 2014 is 10.9% for our sampling, exceeding the global IPD index by 140 basis points. The total return for the 2014 reporting year was 11.8% for the same sampling, which is exceeding the global IPD index by nearly 200 basis points. So obviously last year was accretive to longer-term results among our survey participants. Now, we know that this is not entirely an apples-to-apples comparison. We view the IPD index as a reasonable measure of the global market, and it looks like it was a good year for real estate investors all around. But we do acknowledge that because the index is unlevered property returns, it is not necessarily comparable across all institutions with respect to leverage, risk, and fees and taxes and other deducts from total returns. Moving on to the next slide, we show the breakdown by some of the subcategories of investors. As we've noted, endowments and foundations have the highest target returns at 8.9%, but also very strong performance during the reporting period at 12.4%. At the lower end of the range, insurance companies, with their emphasis on low volatility and the need for stable, current, distributable returns in order to meet fixed liabilities, they have the lowest overall target return at 7.7%, which they slightly underperformed, as you'll see, during the past 3 years. The insurance companies globally were slower to return to the equity markets following the financial crisis, especially given changing regulatory directives, which took time to interpret, and they were specifically moving away from higher leverage, higher yielding products. The endowments and foundations, by contrast, were early entrants to the market, and they focused on high yield investing, and they were rewarded for this early move. At the other end of the risk spectrum, though, were the sovereign wealth funds, who were also early movers following the global financial crisis. They largely emphasized core assets as they returned to the market, and many were new entrants building out their portfolios. They generally acquired prime assets, and though they were only targeting a 7.4% return, they achieved a 13.3% return on a trailing 3-year basis, given the strong and continued performance in the core markets. They'll have to assume they will not continue to exceed these targets by nearly 600 basis points. The next slide shows these target versus actual returns by the domicile of the investors. The Americas, principally the U.S. and Canada, have the highest target returns at 8.6%, as well as the highest average actual results at 11.9%. Higher yielding investments through funds or direct investment are a mainstay for these investors. They have mature portfolios, and they are also benefiting from the capital markets as well as the strong fundamentals, we believe, in their home markets. APAC is next with a 7.7% target versus a 9% actual result. These are strong results, exceeding the target by almost 200 basis points. And as we've referenced earlier, EMEA is lagging in both their target, 7.1%, and the actual results, 8.1%. Again, we think reflecting a slower reentry to the market after the financial crisis due to a variety of factors. We'll move on to the next slide now, which focuses on conviction, what we call our conviction index, the investor outlook for the asset class. We ask investors to rate on a scale of 1 to 10 their view of the investment opportunity from a risk and expected return perspective. Last year at this time, the index had declined meaningfully from the prior year, from 6.4 to 5.7. This year we saw a smaller decline to 5.6. But if you turn to the next slide, we show where the declines have been more pronounced among the endowments and foundations and private pensions. Again, we believe investors that are holding the more mature portfolios. Insurance companies and the sovereign wealth funds, both with lower expected returns, see an improved market for the coming year. But the bigger conclusion is, once again, this year, despite significant inflows to the asset class, conviction continues to decline. I'll now pass the baton to my colleague, Adam Handwerker, who will take us through the next slides.
Thanks, David. We surveyed institutions on their current risk preferences and found that higher-yielding strategies are attracting greater interest from institutions, and that's consistent with the view in the market that core real estate is fully priced. As you can see in the chart on the lower left, approximately 76% of institutions are targeting value-add strategies, and 57% are targeting opportunistic strategies, as compared to 56% for core strategies. However, the risk preference is quite varied by region. Institutions in the Americas are most focused on value-add and opportunistic strategies, which is consistent with their higher target returns mentioned earlier in the presentation, while institutions in Asia Pacific and EMEA remain most focused on core strategies, which is consistent with their lower target returns. It is worth noting that the definitions tend to vary by region. For example, what European investors call value add can be core plus for U.S. investors. We also surveyed institutions on their investment structure preferences. As seen in the chart, the demand for closed-end real estate private funds is strong and has increased as the appetite for higher-yielding strategies has risen. So the percent of institutions investing in closed-end funds has increased from 61% in 2013 to 79% in 2015, as you can see on the chart. In addition, interest from open-end real estate funds is increasing, with 42% of institutions actively investing in 2015 as compared to 30% in 2014. Given that interest, we've seen queues for open-end diversified core equity funds, or Odyssey funds, to be substantial at over $9 billion as of September 30th, 2015, and that represents about 6.5% of NAV for several of the larger funds. Anecdotally, we've seen reports of investors in queues that may not get their capital invested for 12 to 24 months. So with that, I'll turn it over to Will Rowson, who's our partner at Hodes Lyle in London.
Thank you, Adam. I'd like to cover some other investment strategy preferences, principally covering geographies. As the first graphic on this slide shows, institutions in APAC are focused on cross-border investments, while institutions in the Americas and EMEA continue to prioritize their home markets. If you look at the first graphic, you'll see that American investors, this is on the left-hand end of that graphic, American investors focused on the Americas market, and 93% of them continued with that focus, whereas in continental Europe and the UK, the same figure was 87% and 75%. But interestingly, in Asia, only 37% of Asian investors focused on the APAC market. We think that's potentially driven by the additional depth and liquidity of the North American and European markets for those investors, which certainly Asian investors appreciate. Moving down to the second graphic, this relates to the percentage investing in emerging markets. Investors remain cautious about emerging markets, with only 21% of the sample considering them, even though this has increased from 15% in 2014. We think the volatility in global markets, in global currencies, and in commodity prices have encouraged an overall flight to quality. Now, if we could move on to the next slide, I'd like to talk briefly about environmental, social, and governance, ESG, which is covered for the first time in the survey this year. The conclusion was that institutions in EMEA are significantly more focused on ESG investment objectives than institutions in APAC and the Americas. So if you look at the left-hand graphic, you'll see that we asked a question whether institutions have a formal ESG policy or not, and 33% of them said that they had, but leading the pack by quite a long way were EMEA institutions at 61%. We then asked, out of the institutions with a formal ESG policy, which had their investment processes influenced by those policies, and the interesting answer was that 16% of them said they did. Again, EMEA led the way at 37%, leading down to the Americas at 11%. I think the EMEA number really reflects the attitude to ESG, in particularly the Netherlands, France, the UK, and Germany, and the institutions in those markets putting it at the forefront of some of their investment. I'd now like to pass on to Doug Weil to summarize the presentation.
Thanks, Will. In summary, institutional appetite for real estate remains strong. This is driving liquidity in debt and equity markets, as well as driving transaction volumes. But the weight of capital has broad implications for the industry. In particular, the acceleration of capital to the asset class on the positive side might sustain valuations, but on the negative side might stretch, or maybe has already stretched valuations. And at the same time, we're seeing investor sentiment beginning to moderate after several years of growing optimism. I want to read one quote from someone at an insurance company in the U.S. with about $25 billion of AUM, which I think sums up the findings. Quote, "Everyone is scared despite favorable supply-demand fundamentals, and everyone is predicting an increase in interest rates, which they've been wrong about since the 1990s. The greatest risk to real estate will likely come from an unforeseen source, so the mandate should be to continue investing and gain the exposures required of our asset allocation strategies." Thank you. We will now open the webinar up to questions.
Thanks, Todd. We have a few questions in the queue here. The first one is, what is the most surprising finding of the report?
Sure. I think the most surprising finding relates to the divergence in target allocations by size of institution. We were really quite surprised to see that smaller institutions, again, less than $50 billion of AUM, had declined so much year over year in their target allocation by over 70 basis points. This is correlated to a decline in their conviction, and I think in some respects it's probably due to the fact that endowments and foundations in particular tend to approach real estate as a higher returning asset class and perhaps are finding less value opportunity in the marketplace today.
Thanks. Our second question is, with all the talk about investors preferring to invest directly into real estate or access co-investments, why is the appetite for closed-end real estate funds higher than other structures?
Right. I think despite the projections of the demise of the private fund structure following the financial crisis, the results consistently over the last 3 years have demonstrated support for using private funds. We think this is attributed to a couple of reasons. Number one, the survey does include a lot of smaller investors, substantially below $50 billion of AUM, and for these investors, the fund structure works best. They don't have the capital and typically not the resources and bandwidth to have direct investment programs. Secondly, we did note in the allocation survey that investors are moving up the risk curve, and for many investors, their comfort factor in making higher yielding, higher risk investments is substantially greater when it's done through a fund structure versus making individual investment decisions. And then finally, I think we cannot ignore the overall weight of capital trying to get into the market. Even for the largest institutions in the world, they are continuing to use the private fund structure. It is often not what they lead with, but they are re-upping with their legacy managers, and as they go into new strategies and new geographies, they are using a combination of funds as well as direct investments to achieve their allocation goals.
Thanks, David. Our next question is, why do European institutions lag the market from an investment returns perspective? Will, do you want to take that one?
Yes, sure. I will. I think this relates to the pain of the GFC hanging around for longer in Europe. And for instance, in 2012, there was still significant pain, particularly in some of the over-leveraged funds investing particularly in Southern Europe. So that caused those returns overall to still be lower. I think when the American market was beginning to recover, there was still, particularly in continental Europe, some real pain still continuing. I think also the European institutions were investing, as we saw earlier, in their own markets, and because that the hangover from the GFC continued for longer in those markets, then that forced down their returns as well, Adam.
Thanks, Will. Our next question, and perhaps our last question in the queue, is: do institutional investors interested in ESG except for look for market rate returns? David, do you want to handle that?
Sure. I don't know that there's clear evidence that there is no one looking to invest where they would make, I think the term was concessions to overall returns for supporting ESG. Most investors tell us that they are focused on achieving highest total returns. There is some empirical evidence that assets that qualify are going to start generating higher returns. Given that stronger tenant demand, they'll be able to achieve higher lease rates. But our general sense is that ESG is not trumping the need for market level returns as investors are making their investment decisions.
Thanks, David. We're just waiting for some more questions to queue. Bear with us a moment. Our next question is there a sub-stratification of target returns to real estate by strategy, core, value-add, and opportunistic? Earlier slides appear to be a blend of strategies. Similar question for target returns.
Thanks. Our survey did not break out target returns by core versus value-add and opportunistic. We could speak to that maybe anecdotally in the market, and we're generally seeing core in the high single digit to maybe 10%, and value-add being in the teens, and opportunistic anywhere from 15 to 20% plus today in the marketplace. It's a good question, and we'll consider adding that to the survey next year.
Our next question is, do you expect the underallocated funds to attempt to close the gap in 2016 by increasing their investment activity? If so, do you expect it to be with existing managers or new managers?
That's the big question. I mean, on the one hand, investors are significantly underinvested in the asset class relative to their target, and they're increasing their targets. But on the other hand, conviction is declining. So it will be interesting to see whether investors can close that gap. I wouldn't expect it will close materially. It's such a large number. But we are seeing in the marketplace today, investors, despite their increased level of caution, are very active deploying capital into transactions, open-end funds and closed-end funds.
Great. Thanks, Doug. Bear with us as the questions load.
So just following on, there was a second part to that question, which is, if so, do you expect it to be with existing managers or seeking out new managers? And I think what we're finding is that for the most part, investors are decreasing their number of managers in their portfolio and prioritizing existing relationships. The interest for offerings from new managers or emerging managers is growing, but it's still a small part of the market.
Thanks, Doug.
Okay, we'd like to thank everybody for participating today. Again, we apologize for the delay, but we're really pleased with the opportunity to present this research to you, and we're available if you have any further questions or comments. Thank you very much.